People who own property are required to pay taxes on that property. State and local governments rely on these taxes to fund public programs, and there are a couple different ways these property taxes are calculated. The simple way involves multiplying the assessed value of the property by the established tax rate. So, say we have a property that's valued at $622,000. If the local property tax rate is 5.5%, our formula would look like this. Or, we get a total amount of $34,210. Different municipalities use a slightly more complicated system called millage. With millage, the taxes are calculated on a per $1,000 basis. This requires a slightly different formula. For example, a property owner owns a small building valued at $118,750. The building is located in a municipality with a 25.67 millage rate. We start by multiplying the assessed value by the millage rate. Now we divide the result by 1,000. Rounded to the nearest whole cent, the property tax payment comes to $3,048.31. When someone is calculating property taxes, the basic value of the property is sometimes called the basis. The basis is the number that's multiplied by the tax rate. This basis may end up needing to be changed depending on circumstances. What's then created is the adjust basis. To find a property's adjusted basis, you use this formula. Purchase price plus improvement value plus total accumulated appreciation equals adjusted tax basis. To ease some of the expense associated with property ownership, the IRS allows business owners to take what's known as a depreciation deduction on their federal income taxes. In effect, the depreciation deduction allows the business owner to gain back over time the initial investment in a building. Not every property qualifies for this deduction. In general, the property must produce income or be part of a business operation. Before the deduction can be calculated, the basis of the property needs to be found. This is a little different than the other basis we were just talking about. In this case, we'll use this formula. Purchase price minus land value equals basis. This basis may end up being adjusted for a number of reasons. The basis may be increased if the building is improved or expanded, or it might be decreased by the total amount of depreciation deductions that the property owner had or should have taken. There is more than one way to take a depreciation deduction. However, we've only talked about the straight line method, which is the simplest. Since we're looking at the straight line method, we need to bring up what is known as a recovery period. This is the amount of time during which the depreciation deduction can be taken. The recovery period varies depending on what type of property is subject to the deduction. Residential rental properties have a 27.5-year recovery period. Non-residential real properties have a 39-year recovery period. To determine the annual depreciation deduction, use this formula. Basis divided by recovery period equals annual depreciation deduction. Here's an example. Virginia recently purchased an office building with the intent of housing her advertising business there. The building was purchased for $426,250. She wants to know what kind of depreciation deduction she can expect to take out of taxes the business pays each year. Assuming no other additions or improvements to the building, the basis value is the purchase price, $426,250. Office buildings are normally classified as non-residential real property. This gives us the recovery period of 39 years. So we'll use the annual depreciation deduction formula. Then, when we divide the basis by the recovery period, we end up with $10,929.49 annual depreciation deduction. So Virginia can expect to take that amount as a deduction from the taxes paid by her advertising business. The last tax-related area we'll talk about is transfer taxes. These are taxes that are applied to the transfer of property ownership. Sometimes these taxes are also called conveyance taxes, and occasionally they're imposed through a system of revenue stamps. Determining transfer taxes uses the same formula that's used to determine property taxes. Assessed value times tax rate equals transfer taxes. And if the tax rate uses millage, then we use assessed value times millage rate and divided by 1,000. This then equals the transfer taxes.